Right, welcome and good evening. Today is Monetary Economics Day, and we are on Chapter 5, Behavior of Interest Rates.
Sorry, Trevor.
Yeah,
Sorry to speak over you. The document that you're sharing now is the same document that was sent earlier in the group.
correct, yes. It's
Okay,
the same
thanks.
document. Notes.
Okay.
So if you just scroll, I think on the last chapter there, chapter number 5. All right, so it's the behavior of interest rate. So the notes are very brief and straightforward. Our module is also brief and straightforward. But what's nice about this is it basically gives you ammunition, like I was saying earlier, that maybe next week we are going to be engaging in that discussion. So we have more ammunition than a layman, right? We are talking in economics terms. We are understanding some of the effects on, or the economic effects of some of the decisions that are made at government level. So it basically gives us a good starting point, a good, a strong background in that. Right, but today we are looking at the behavior of interest rates, right? Basically looking at the behavior of interest rates, another interesting and short topic. All right, so our starting point now is to discuss the determinants of assets, of an asset's demand, the determinants of an asset's demand. So we are gonna see this again much later, but number one, we have wealth, right, which is the total resources that are owned by an individual, including all assets, right? Including all assets. So that should pretty much give you a person's wealth, which is a stock variable. I think you do remember the distinction there. But I can't remember if it was on our assignment question where they were saying what sort of things would constitute a person's wealth, and then they give you maybe a person's gold, a person's maybe salary, etc., and then you're supposed to choose from there. So all that we got to do in those circumstances is to just remove the floor variables there, right? Something like a person's income, right? It contributes to the wealth, but it will not in itself be wealth, right? Expected return. So what expected return is that? So we're looking at the expected return of an asset. So an increase in an asset's expected return relative to alternative assets, holding everything else unchanged, raises the quantity demanded of that particular asset. So back to the discussion I think that we had last week, if you're going to look at bonds and money as assets, right? So if the return on bonds is bigger than the return on money, then obviously you're gonna have to demand more of bonds. Is that simple? So that is why we had that graph there, right? So the other thing on this here, it's important to realize that when we look at the expected return, we are going to be looking at this relative to other assets, right? So assets are not just limited to bonds and money, right? Assets also are, you could also be buying shares, equities, etc. So you're also going to be looking at the return of these different assets, right? Many of these different assets. So if one is doing well relative to others, then you want to drift towards that one there. All right. And again, the most important thing is holding everything else unchanged, right? We are looking at these things in isolation. Risk, holding everything else constant. If an asset's risk rises relative to other alternative assets, its quantity demanded is gonna fall, right? So you really don't want to take unnecessary risk, you see, as an investor. Risk is good if there's a good return attached to it, but it has to be necessary. So if you have, since we are saying holding all things constant, so if you have two assets that are essentially the same, and then one has more risk than the other, you are bound to demand more of the one that doesn't have risk. And then the liquidity, again, the more liquid an asset is relative to alternative assets, holding everything else unchanged, the more desirable it is, the greater the quantity demanded of that particular asset. So liquidity, we are talking about how quick it is for you to convert that asset to cash. So if you're looking at if you are doing management accounting and costing, right? There's a topic that you're gonna do much later about the valuation of shares, not shares, sorry, the valuation of companies, particularly private companies which are not listed. Then we're saying if you buy shares from a private company, those shares are not liquid, meaning you can't easily dispose of those shares. You can't easily convert them to cash, right? You can as well find yourself sitting on a bunch of shares that you can't sell. They are unlike listed shares. Those are very liquid. You can basically buy and sell them any time of the day, right? In theory. So liquidity is essential. You don't want to buy an asset that you can't dispose of. All right. And then supply and demand of the bond market. So now we are looking at bonds specifically as an asset, right? Bonds specifically as an asset. So supply and demand in the bond market, we see how the price of bonds is determined, right? The bond price is associated with a particular level of interest rate. So you will realize that the price, I think I also mentioned this on the last session where we said the price of the bond and the interest rate, those two are inversely related, right? They have a negative relationship. Every time the price of the bond is high, interest rate has to be low, right? Those ones are always going to be negatively related. So there's a calculation for that there in the textbook, but it really doesn't matter for you to derive that. What's important now is to know the relationship between those two. Right, then the demand curve basically shows or gives us the relationship between the quantity demanded and the price. So obviously, because we know the relationship of the price and the interest rate, then you can obviously derive a relationship between the quantity demanded and the interest rate as well, right? If you'd like, but normally we plot it against the price. We normally want to plot it against the price, all right? So you will realize that, again, if you are doing financial maths, yeah, let's talk about financial maths and financial management also, MAC 3702 or 61. There are parts where you need to find the present value, which is actually the market value of a bond, let's say, or any debt instrument. So you will realize in your calculations that every time the interest rate is high, it's going to give you a lower price, and every time the interest rate is low, it's going to give you a higher price. That's basically how it works. So it shows us the relationship between those two there. All right, and then the rest of that you can read, but basically there in the diagram it gives you that relationship there where you have a supply and a demand curve, right? The supply and demand curve for bonds, and then the price obviously on the vertical, and then the quantity on the horizontal. All right, so the downward sloping demand curve, there is a downward sloping of the demand curve and supply of bonds. Okay, I miswrote that there. The supply curve is supposed to be upward sloping, right? So it indicates that lower price of the bond, the demand, the lower the price of the bond, the higher the demand, right? All right. Or maybe I should have just deleted that supply of bonds and kept it as there is a downward slope for the demand curve, right? To keep it simple like that. So what does it signify? The basic law of demand, right? That every time the price is high, the demand is going to be low. And when the price is low, the demand is going to be high, right? So if I tell you that the interest rates are low, you should pretty much know that it means the price of the bonds is expected to be high, and vice versa, right? The supply curve shows the relationship between the quantity supplied and the price. When all other supplied and the price, when all other economic variables are held constant, right? No, my writing was bad here. All right, there is a positive relationship between the quantity supplied and the price of the bond. So you can pretty much see that there by that upward slope there, which is BS, which is the bond. Right. So obviously where those two there coincide, where those two graphs coincide, it's going to give you the equilibrium, which is our point C there. So any price that lies above PO, that lies above the equilibrium price, is going to give you excess supply. What is excess supply? It's when the quantity supplied of bonds exceeds the quantity demand, the quantity demanded. And then right at the bottom there, you're going to have excess demand, right? What is that? You can see from the graph there, wherever the quantity demanded exceeds the quantity supplied. So this always occurs when the price is going to be lower than price. All right. So what then can change the equilibrium interest rate, right? So the equilibrium interest rate, as I already mentioned, is reflective of equilibrium price, right? The equilibrium interest rates tell you about the price. Okay. So what are those? You can either look at movements along the demand or supply curve, right? Movements along the demand or supply curve. So this is when the demand or the supply changes as a result of a change in the price of the bond or a change in the interest rates, right? So that's basically a movement along. So a change in the interest rates basically gives us a change in the price, right? So that will cause a movement along any of those curves, right? And then other than that, you can obviously have shifts on those graphs. So either a shift in the demand curve or a shift on the supply curve. So what are the factors that can cause a shift on in the demand for bonds? So those are the factors that we spoke about there earlier, beginning, which are the determinants of demand. So all of those, they basically cause shifts. So remember, any factor that is exogenous in our model, so in other words, any factor that is not your price or your quantity there, is basically gonna give you a price, definitely gonna change or shift any of those graphs, either the supply or the demand. So factor number one, you're gonna look at the wealth. Now we are looking at demand, right? Factors that can change the demand. So if you look at wealth, how do you think wealth could affect a person's demand? Think about a situation when you suddenly feel wealthier. There's an economic boom, things are going well, like in 2010 there, during those times. You're obviously gonna demand more of an asset, right? You're gonna demand more of an asset. So remember, the determinants of demand for an asset are the same as the determinants or the causes of the shifts in the demand for bonds, because a bond is an asset. You hold a bond as an asset, right? So it should behave just the same. So when times are good and people are wealthy, that you are going to demand more of your bond. So when your demand is increasing, that's a rightward shift in the demand curve. You should remember that, I think, from second level or first level. And then when there's a recession now, when things are bad in the economy, we are not feeling wealthy. Basically, our demand for bonds is gonna lessen. So it's gonna be a shift to the left there. All right. And then expected returns again. So if higher expected interest rates in the future lowers the expected returns for long-term bonds, and therefore it decreases the demand and shifts the demand curve to the left. All right. So which means if we're expecting that the interest rates are gonna be high in the future, what does that mean in simpler terms? We are saying that the price is gonna be low in the future, right? Because the interest rates are gonna be high. That's what that one basically means there. So when that's the case now, you don't want to buy an asset. Of course, people do that a lot now with cars, right? But you don't want to buy an asset that's gonna lose, that you know is gonna lose value in the future. So if you know that the interest rates are gonna be high in the future, it simply means that the price of that bond is going to be low in the future. So you are buying high to sell low. Doesn't make sense, right? So you would rather not buy that. So hence there's going to be a leftward shift there. So obviously the opposite there is going to hold true, right? Risk. If the price in the bond market becomes more volatile, the risk associated with the bonds increases and the bonds become less attractive. Like we already said, you don't want risk, unnecessary risk. You don't want that. All right. And then increases in, this is liquidity now. So a liquid bond is a bond that's basically, it's a bond that's basically marketed, right? It's a bond that's going to be marketed. Let's put it this way. Suppose you are looking at two bonds, right? And you know, companies can issue bonds as well. We call them corporate bonds, right? So there are certain companies that if you buy a bond from that company, it's not easy for you to dispose of that bond. So in other words, they are not liquid bonds. You can't easily sell them, right? In other words, they don't move fast, so the demand is probably low on those bonds. So you don't want to buy those bonds. So it means if the reason is because the demand is low, then it's gonna get lower, and it's gonna be represented by a shift there to the left. It's gonna be represented by a shift to the left. So the more liquid an asset is, like we established there on the determinants of demand for an asset, the more desirable it is. So same applies with bonds. So you want to buy bonds that you can easily dispose of. Say bonds from a company like Microsoft. You know that those ones sell very fast. Unlike, say, bonds from, let's think of a company, say, maybe iTech. You know iTech, you probably don't know that company. So why would you buy a bond, an iTech bond? You see, so it's not a liquid bond. All right, and then supply. So there can also be shifts again in the supply of bonds. So now we are looking at factors that can cause a shift in the supply curve of bonds, right? Expected profitability of investment opportunities. So now, who supplies these bonds? So corporate bonds could be companies. So when do they supply the bonds? When they need to raise cash, right? Cash for what? For investments, right? Cash for investments. Sometimes the government also does issue those bonds when they want to raise money through the Reserve Bank, right? They issue those bonds. What do they use the money for? They have projects, right? They have projects. So if we think of how profitable a project is, then we can determine whether the supply is going to shift to the left or to the right. So if the profitability is expected to be high, then we are more than willing to supply bonds in the market because we need cash and we expect that we are going to get a good return, right, in that investment that we want to engage in as an organization. So at government level, think about the investment that we, Minister Nathi Mthethwa wanted to engage in. We wanted to build a big flag, a huge flag for a huge cost. So how profitable is that going to be? Not so profitable, right? So it's going to be hard for him to raise, or it was basically going to be hard for him to raise, should need be to raise funds for that, right? So particularly if you're going to be raising funds through the bond market, then we would want to fund such a project. You see, Tottenham spare such deals, right? We are looking at such deals. And then expected inflation, right? An increase in expected inflation causes the supply of bonds to increase, right? And the supply is gonna shift to the right. So what effect does inflation have on bonds? I think we had that talk in the assignment. We said the cost of credit is low, right, when there's inflation. So in other words, if you are borrowing and you expect that there's gonna be inflation, it means that we are expecting that your cost is gonna be low, right? Remember, we made that example and said, okay, let me simplify it again. When you go to the bond market, right, to get a debt, or let's say when you issue bonds in the bond market to acquire debt financing, the cost of that debt is usually the interest rates there. It's basically the interest rate that is charged there. It's the cost of that debt. So there's a nominal cost, which we said there's a difference between the nominal interest rate and the real interest rate, right? So given you are going to be charged a nominal interest rate, say of 5%. So what happens now when you expect that the inflation is going to increase? It means that the real cost of borrowing is going to go down. So in other words, the real interest rates are going to go down. So in other words, if your borrowing is 5% and then your inflation rate is 2%, the real interest rate is 5 minus 2, which is 3%, right? Suppose it's going to go up, your inflation, your borrowing is 5%, which is your interest rate. Suppose your inflation has gone up to 4%, then your real cost of borrowing is 1%. So that is why, or that is how inflation basically benefits the borrowers, which is the supply side of this bond market now, right? So which means when they expect now an increase in the future inflation, right, it basically means the supply of bonds is going to go up, right? The supply of bonds is going to go up because people are willing to supply bonds because they know in just a short space of time, the real cost of borrowing is going to go down. So the opposite works there with the opposite would work there with the demand curve, right? So the expected inflation also has an effect on the demand curve, right? And it moves in the opposite direction. So once you are aware of that expectation, your demand for those bonds is going to go down while the supply goes up on the other side. So we'll see the effect of that later. All right, and then the other one is government budget, right? So higher government deficits increases the supply of bonds. Why so? We discussed this again, I think, over the assignment, that a deficit means more government borrowing, right? And then some of those funds are going to be coming from the bond market, right? So when there's a high deficit, then you expect a rightward shift in the supply curve of those bonds, right? So that's what basically that is there. All right, and then the liquidity preference framework now. This is from the economist John Keynes, right? Very popular, and his followers were the Keynesians, right? So the liquidity preference framework determines equilibrium interest rates in terms of the supply and the demand of money. So there we're determining the interest rates, right, which is the price of the bond, because there's a relationship now between the price of a bond and the interest rate, right? Generally, and we could basically sum that up and say, and give it one interest rate in the market. So there's a relationship between those there. So which means you can basically use the bond market to find interest rate, right? That's according to what we're doing now. But Keynes again now has come up with the liquidity preference framework. So he says you can basically determine the equilibrium interest rates in terms of supply and demand of money, right? So he assumes that there are only two categories of assets which people store their wealth in. So this one we are very much familiar with, right? Money and bonds, right? Money and bonds. As such, the quantity of money and the bonds supplied must equal the quantity of money and the bonds demanded. So that's basically it there. So if you look at it there, all right, it's supposed to be all right, I think I miswrote that there. There's supposed to be an equal sign there. So the supply of bonds and the supply of money is supposed to be equal to the demand of bonds and the demand of money. So M there is money. So on the second plus there, just put an equal sign there in your mind. I'm gonna correct that in the next notes that I'm gonna send, right? And then you can basically collect those terms together there, right? So if you bring bonds on one side and then you put the money on the other side, so as an equation, it should still hold true there, right? So what does that tell us now? So this tells us that if the market for money is in equilibrium, therefore MS, which means the supply of money, must be equal to the demand of money. So MS must therefore be equal to MT, right? So this is when the money market is in equilibrium, right? And then the right-hand side of the equation is going to equal to 0, right? Implying that the bond market is also in equilibrium, so which is the supply of bonds being equal to the demand of bonds there. So what does he assume now? He assumes that the money has a 0 rate of return. So this we are also well aware of, right? Money has a 0 rate of return. So I think we remember the example that we gave. We said if you stash your money in your mattresses, it's not going to give you a return, right? But the bond market, of course, is going to give you a return. So bonds, the only alternative assets to money, we have an expected return which is equal to the interest rates, right? Therefore, as the interest rates rises, holding everything else constant, the expected return on money falls, right, relative to the expected return on bonds, right, leading to the fall in the quantity of money demanded. So this is basically from, I think we did this graph on the money market second level, where you had the demand curve having that demand curve having that inverse relationship there with the interest rate. So this is what is being described there. So also, as the interest rates rises, the opportunity cost of holding money, so which is the interest that could have been earned through holding bonds, right? So that's what happens when the interest rates rise, right? Increases also leading to the fall in the quantity of money demanded, right? So it is also assumed that money supply is controlled by the central bank. So how do we know that? We do remember that there was a straight line that was representing the supply of money there. So where is equilibrium? All right, where is equilibrium? Equilibrium is basically going to be where those two coincide there. All right, so excess money supply means people are holding money that they desire. So they will try to get rid of, holding more money than they desire. So they will try to get rid of their excess money balances by buying bonds, right? And subsequently, they will bid up the price of those bonds. And when the price goes up, what happens to the interest rate? The interest rate is going to fall there. So let's look at that situation there on the graph. Right, let's look at that interest rate there on the graph. So if you have got excess supply of money, right, if you have got excess supply of money, this is the situation. An example of the situation is what I was talking about there from the previous government. Let's say they have printed a lot of money, right? They have printed a lot of money. So once they've printed a lot of money, then there's a lot of money that is in circulation, right? And then people are holding more money than they desire. So what will they do there? The response is going to be buying bonds, right? They're going to take that money and buying bonds. Why so? Because they are assuming that there are two assets. You can either hold your money as money or use that money to buy bonds, right? So at that point, right, the interest rate is high there, right? The interest rate is high. So when the interest rate is high, what's happening to the price of the bond? The price of the bond is obviously low, right? So which is the point on top there, right? The first line on top, right? So the price of the bonds are basically low. There's excess money supplied. The interest rate is high. So what are people going to do? People are going to be buying bonds. So as they buy bonds, what's happening to the price of bonds? The price of bonds is going up, right? And as the price of bond is going up, what's happening to the interest rate? The interest rate is following. So that's the downward pressure there. So it's exerting pressure going straight down to equilibrium there, point E, right? And then the same would happen there when you have excess demand, right? It means that people want to hold more money than they currently have. So what are they going to do? They are going to sell their bonds, right? Which is the only other asset there under the assumption. John was assuming two assets then, right? So you're going to sell your bond. So what happens when you sell your bond? What happens to the price of the bond? You are basically flooding the market with the bonds, right? So the price is going to go down, and then what's going to happen to the interest rate? The interest rate is going to go up. So hence that upward pressure there towards equilibrium. All right. Now let's look at the changes in income. So something that we already know again, right? So these are some of the determinants there of, it's a lot similar again to what we're discussing, but I think if you remember, it's not really mentioned here in these notes. But if you remember, back in second level, when we're looking at the money market, right, and you're particularly looking at the demand of the money market. So John was actually talking about 3 reasons why people can hold money, right? So the one that we are dealing with here is for speculative reasons, right, which is going to be affected by the interest rates. And then the other one was for precautionary reasons. And then the other one was transactions, general transactions, right? So the money that is held particularly for transaction purposes can cause the demand curve to shift, right, to the left or to the right, depending on what happens to a person's income, for instance. So when a person's income increases, there was a shift to the right, right? People wanted to, engage to do more transactions as a result of that. And then when people's real incomes fell, then it meant a leftward shift there on that curve. So that one is not repeated here, but I'm just filling you in on that, right? So that's what is being spoken about there on the first dot. So when income is rising during a business cycle, expansion, holding all other things constant, what's going to happen to interest rates? Interest rates are going to fall, right? Why so? Why are they going to fall? Why are they going to fall? Basically, this market has to be in equilibrium at the end of the day. So once there's a lot of money now that's available, to keep the market in equilibrium, because there's a fixed supply of money, to keep the market in equilibrium, what's basically going to happen is the interest rates are going to rise, and then that's going to lure people into the bond market. So when the interest rates are high, the bond prices are low, right? So because it's an asset, you always want to buy when the price is low, right? Demand for an asset, remember, the lower the price, the more you want to buy that asset, right? And then changes the price level. When the price level rises, the same nominal quantity of money is no longer as valuable, as it cannot be used to purchase as many real goods and services that should have been real goods and services as before. So to restore their holdings of money in real terms to its current level, people will want to hold a greater nominal quantity of money, right? A rise in the price level will therefore cause demand for money to increase. So obviously, when there is inflation, what do? You want to have a lot of money, right? Basically, your transactions are now expensive, so you basically want a lot of money. So this is what is being spoken about there. So the money demand curve will shift to the right, and the equilibrium interest rate is going to increase. So the opposite of what happened there. So when the price level increases with the supply of money and other economic held constant, the interest rate is going to rise, right? So which is pretty clean there. Because when the demand of money rises, what happens to inflation? From another perspective, what happens to inflation? Inflation is basically going to increase. What's the response? What's the normal response to keep things in equilibrium? So the reason why there's an adjustment there in the interest rate is because the money is fixed, right? Money is that straight line, it's fixed. So you can't satisfy the demand of money by printing more money. You don't want that. So to avoid that, what you do, you increase the interest rates to reduce the money that is in the market. So that's the explanation there of what's happening. All right, let's look at changes in the money supply. Right, an increase in the money supply is engineered by the central bank and will shift the money supply curve either to the right or to the left, right? Then it's going to lead to a fall or rise in the equilibrium interest rate there, right? And then if there's an increase in the money supply, it's going to cause the interest rates to fall, right? Of course. So this is particularly known in countries like the United States, right? This is how they operate their monetary policy. They basically increase or reduce the money supply, right? And then because of an increase in the money supply, so it has an expansionary effect. So it's usually the expansionary monetary policy, right? We expect that it should raise national income and wealth, right? And then the income effects thus predict that an increase in the money supply will lead to the rise in the interest rate in response to the higher income levels. So this is to keep that there in equilibrium, right? So an increase in the money supply can also cause an overall price level of an economy to rise. So I've also seen this before. So whenever they want to boost the economy, what do? They increase the money supply. So what we do here, we do increase the money supply, but how do we do that? We vary the interest rate, right? We particularly take the interest rate down. And what happens? Remember the other day we were talking about how the interest rate has got an effect in the money creation process by banks. Right? So in other words, you can go and take up more loans from the bank. So in other words, money supply is being increased in that regard there, you see. So that's basically increasing. So lowering the interest rate is basically increasing the money supply, right? But what happens when you do that? There's going to be inflation, right? There's obviously going to be inflation. And what will your response be to inflation? Then you might want to increase the interest rates again to cap the inflation. So you always want to keep things in equilibrium, right? You always want to keep things in equilibrium there. So hence, these changes that we do, economists have always argued that they don't work in the long run, right? They don't work in the long run. For example, what you are talking about, what good is it for you to print more money to boost an economy, but you get inflation? Say, okay, let's not talk about printing money. Let's bring it down here to the South African Reserve Bank. You lower the interest rates like what they did soon after 2020. You lower the interest rates to boost the economy. And then soon after that, you need to, to increase the interest rates because there is inflation that is going. So it's like you're taking steps forward and then steps backwards again, you see. So hence we say in the long run, the question is, in the long run, can you boost an economy through expansionary monetary policy or expansionary fiscal policy? Can you really boost an economy in that regard? Considering that you are gonna lower the interest rates to boost the economy, and then it's gonna result in inflation, and then you're gonna reduce the inflation. To reduce the inflation, you're gonna increase the interest rates. So you're moving back and forth there. You see, but that you can think about also, and then we talk about some other day. So the higher inflation rate results in the increase in the money supply. Sorry, as a result of the increase in the money supply also affects the interest rate. So the expected inflation effects also predicts the rise in the interest rates in response to the rise in the expected inflation rate. So this is what is basically being spoken about on that day. Right. I don't know what questions you guys have with regards to what we discussed here tonight. We address them before we call it a night. All right, no questions. Perfect. So on our next session, remember the part that I said I'm gonna bring in some guys there. So I think we are gonna have a week to prepare for that. Right, a week to prepare for that. So I think the link has been sent in the group, so we can all listen to that and then hear from your perspective, right, what you need to say about that. So should you be asked to give an intelligent opinion about that, then do let us know in our next session. And then also on Palapala, I'm gonna look for stuff there on Palapala, and then we can have a big discussion on that.